Hello and welcome back to WealthLab. In today's video, I will take you through one of my most favorites and most acknowledged write-ups of the time. It was written on December 13 on why the next 5 years won't look like the last five in Indian equities. So this is as important as it was on December 13th as it is today, even more. And you will ask why. Today and in the past 2 3 days, we have seen everything falling. US equities are down, Kospi is down, safe assets like gold and silver are down, Indian equities are down, Bitcoin is down. Everything is taking a hit, everything is in red. And I would like to tell you why. First thing that is very important is that no returns can be created without earnings. No returns can be created without earnings. That is, if there is no earning growth, then the stocks will not grow. Why will anyone invest in a company where the earning visibility is not there, where the margins have peaked, where the company is not growing but is stagnant, or the company is overpriced? People realize this much later and start chasing the multibaggers of the past rather than basing themselves in the data. People have a tendency, supposedly something has grown by a lot in the past, we have a tendency to overreact, overshoot, and overcommit. That is human nature, and that gets translated into the markets as well. So let's take you through it, one chart at a time. Over the past 5 to 6 years, small cap has gone up by 389%, mid cap has gone up by 409%, and Nifty 50 has almost tripled to 201% from COVID lows. This is not normal. These returns are not normal from COVID lows. Of course, the data is from COVID lows, so it's looking a bit too high, but this data is not normal. This is too much. 2.5%, two and a half, two times a large cap index. But let me take you through the stats one by one. So this is the absolute return of Nifty 50 that we just spoke about. This is rebased to zero at the start of the crash. And over here you can see small cap, mid cap, and large cap. These are how the returns are stacked at this point. When you talk about CAGR basis, you will be able to see that the 5 year CAGR of Nifty 50 is 14% versus mid cap at 24% and small cap at 20%. Is it normal? How do we categorize this as normal or abnormal? Let's look at the 10-year CAGR. And so if it is falling in line, then that means this is fine. But if it is not falling in line, then that means something is off. So the 10-year CAGR of Nifty 50 is 13%, 5 year is 14%, perfectly fine. This is normal. And this is still overshooting, but we can still live with it. Not a major impact. For mid cap, we are 9% above the long term average. And for small cap, we are similarly 8% above long term average. What does this mean? This means that if we have to hit the long term average, we will have to significantly underperform over the next 5 years so that this average comes up. If we have overshot, we will have to undershoot so that this happens. And that is human behavior. We tend to overshoot and we tend to undershoot. We tend to fully commit and not commit at all. Even supposedly you do get scared of something, you touch uh, you touch a hot plate or boiling water, and the next time you are scared of water itself. A dog barks at you and the next time you are scared of all dogs. So we live in extremes, and we work in extremes, and that is exactly what gets reflected in the market. This exceptional high return was an extreme performance, and we will have some, don't want to say it, we will have some lower returns also, which will be a impact of an underperformance in the market. Only over a long period of overperformance and underperformance can we achieve the median, and this time is never different. Every time is the same. This time is not different. So this data says that we are going to be in a period of some underperformance, at least from a mid cap and small cap level. So case in point number one, Nifty 50 large caps is where you should be if you have to hide or if you have to invest your money somewhere. Now let's go to the other second chart. The second chart is a long-term view of the same indices, absolute return since 2005. Over here, you will see that small and mid cap often tend to run higher than the large cap, and then there are periods of correction or consolidation. Runs higher, consolidation. Runs higher, consolidation. So this red boxes are where there is a significant alpha in small, mid, and large, small and mid caps versus large cap. and the green box is when the alpha converges. Right now, this is the red box, and the alpha is stretched by a huge margin, and there will be a time when we will converge back. Case in point two, that large caps might be better because if this starts to fall, this will catch up. Over here, we saw in 2016 to 19 that mid and small caps were falling and large caps kept rising. Index kept making newer highs before we converged. This is a possibility. Nothing over here is a fact. It is all data driven possibilities. I am not a registered advisor, and you should do your own research before investing. Now let's go to the third chart, which is the fundamentals, the median P. For Nifty 50, we are not too far from the median P. This is from December, so right now we have corrected much more. We are still under, I think, median P. We are reaching there. For mid cap in December, we were overshot by a huge margin. For small cap, we were still fine, but the problem here again is that small caps are the first to be hit by any global calamity, war, recession, any slowdown, because so many people are into it. A lot of retail investors are into it. That when they stop performing or when something goes bad, they are the first one to rush out, and this comes crashing. So investing in a small cap, you should always be very cautious. You should always look for value over momentum. Value plus momentum is the best phase to be in, but these alphas keep changing. Sometimes it will be favoring momentum, sometimes it will favor value, sometimes it will favor something else. So this is very important to acknowledge that equal current and median P is also not great for small cap. Might be good for Nifty 50, but definitely not great for small caps. Now let's go to the chart 3. This is a chart by DSP Mutual Fund, and it is something similar to what we discussed above, the red and green one. So it shows outperformance of small and medium mid caps over large caps. These are green. Underperformance is in red. So there are periods of underperformance, outperformance, underperformance, outperformance, underperformance, outperformance. There was a period, now currently we are in a period of outperformance, uh, which we saw up until last year. Now there might be a period of underperformance for some time for small and mid caps, and this is relative. So case in point number 4, large caps are better and less volatile at this point. Now let's move on to chart 4. This is the weight of top 10 stocks versus the total market cap. This is also from DSP Mutual Funds. So the weight is currently the lowest, correct? So whenever the weight is lowest, we have seen an uptick, we have seen an uptick, we have seen an uptick. Now this is the lowest in maybe the last 20-21 years, and we will see an uptick in the market cap of top 10 stocks. Similarly, for the top 50 stocks, we are at the lowest right now, and we can see an uptick. So case in point number 5, an uptick can only happen if either the large caps, the numerator, starts to go up, or the small caps, the denominator or the total market, starts to go down. In both the cases, this happens, and in both the cases, large caps or Nifty 50 or Nifty 100 is what wins. This is the volatility. If we have to be in a volatile environment and the returns are more or less the same, if you don't have it in you to hold through the volatility, you're better off being in Nifty 50 than in mid cap and small cap. Along with this, I will like to show you a couple of other indicators from WealthLab. So over here, we can go to the market rotation indicator, and this is basically a Nifty mid small 400 divided by Nifty 100 ratio. And if you see, when the ratio is above the 200-day moving average, it favors large cap. It means that you should be in if the ratio is above the 200-day moving average, it would mean that you should favor mid and small cap. When the ratio is below, it would mean that you should favor large cap. Right now we are below, so we are below. Past 1 month, I'm sure definitely we are below. So for the broader market, below this whole range, it is tracking 1990 stocks, and it is clearly saying that favor large caps. Now let's go to the RS screen. RS is relative strength. That is how is a stock compared to the whole market. So a RS of 99 would mean that it is performing better than 99% of the stocks. So over here, 81 to 100 RS, that means top 20% of the stocks in the unit. More than 58% are in mega and large cap. So 59% actually are in, actually it has moved to 60%, 61% stocks are from mega and large cap. This means that the majority of strength is in mega and large caps, and only 40% of stocks are from mid, small, micro, and other. This also clearly signals, case in point 6, that mega and large caps are being favored in the market, and this is exactly where you should be. With all of this being stated, this is what I'm trying to bring to your notice, that we should not try to chase the runners of the past to predict the runners of the future. We should stay in the moment, in the data that is today, and try to base our investments basis of margin of safety. Margin of safety meaning where the risk is the least, because the return is in no one's hand. We don't know how much a stock will rise, we don't know which stock will rise. But if we are placed in a place where there is more margin of safety, where the bottom is near, where or maybe a very tight support is there, where it is being ignored, or where the fundamentals are great, where there is margin of safety along with an upside potential, that is where you need to be, at least in this environment. 2022, 2023, 2024 was a place where you could be anywhere where there is momentum. That was a time for momentum. Right now is the time for value. So, and there will be again a time for momentum, and there will be again a time for value. Right now we are in a value cycle, and we need to be placed in a values in value stocks, where there is good earning visibility and right pricing. On this note, I would like to close this, and I would like to thank you all for giving me your time. And I would like to again say that place yourself in the right sector, the right industry, the right stock, the right market cap, and do yourself a favor. Thank you for being a part of Wealth Lab, and wishing you a very happy Holi.